The Federal Reserve just made a mistake that retail investors completely missed, but the smartest money on earth saw it instantly. In the last 72 hours, insiders have been quietly moving billions of dollars out of paper silver and into physical silver. Silver dealers are reporting record demand, vaults are running low, premiums on physical coins are spiking, and the official price sitting at $76 an ounce. Suppressed, manipulated, and about to explode. In the next 12 minutes, I'm going to show you exactly what the Fed did, why it matters, and what the smartest investors are doing right now to position themselves. Here's what I'll break down in this video. Number 1, the Fed decision that caught retail completely off guard. Number 2, the historic 8-4 split that hasn't happened since 1992. Number 3, why insiders are dumping paper silver and buying physical. Number 4, the exact pattern that happened in 2019, right before silver doubled. And number 5, what you should do right now if you want to position yourself before the next major move. Pay special attention to point 3, because once you understand the difference between paper and physical silver, you'll never look at this market the same way again. Let me start with the facts. On April 29th, the Federal Open Market Committee held the federal funds rate steady at 3.5 to 3.75%. This was Jerome Powell's possibly final meeting as Fed chair. His term ends in May. Markets had priced in a 100% chance of no change. So far, so normal. But then something shocking happened. The vote came in 8-4, 4 dissenting members. The last time 4 FOMC members dissented was October 1992. Read that again. 34 years. This wasn't just a policy decision. This was a public revolt inside the most powerful central bank on earth. Some officials wanted aggressive rate cuts. Others wanted to maintain the pause. A few even pushed for the possibility of rate hikes. The Fed is fundamentally divided, and the market noticed. Here's where the mistake becomes obvious. The Fed simultaneously did 3 contradictory things. 1, they held rates steady. 2, they raised their 2026 core PCE inflation forecast significantly. 3, they cut their projected rate cuts from 2 to just 1. Stop and think about that. Inflation is going higher, but rates are staying high, and cuts are getting pushed back. This is what economists call stagflation risk. The Fed is admitting that inflation is sticky. Energy prices from the Strait of Hormuz crisis are not coming down. The labor market is weakening, but they cannot cut rates without unleashing more inflation. They are trapped. And here's the part retail investors missed completely. In the FOMC minutes, policymakers expressed serious concern about the closure of the Strait of Hormuz. They said it could trigger a structural energy shock. Translation? The Fed is bracing for another inflation wave, and they have no tools left to fight it. This is the exact environment that silver was built for. Now, here's where things get really interesting. There are 2 types of silver in the world. Paper silver, things like silver futures contracts, ETFs, and certificates. You don't own the metal, you own a promise. Physical silver, actual coins, bars, and rounds. You own the metal itself. For most of modern history, paper silver tracked physical silver almost perfectly. But something strange is happening right now. The paper-to-physical leverage ratio in the silver market has reached 21-1. That means for every ounce of physical silver in storage, there are 21 ounces of paper claims. Now imagine if everyone with paper silver suddenly demanded physical delivery. The system would break in hours. This is what insiders understand, and this is why they are quietly moving. Bank of America, JP Morgan, Sprott Asset Management, major sovereign wealth funds. All have been increasing physical silver holdings while reducing paper exposure. Why? Because they know what happens in a real crisis. In 1979, in 2008, in 2020, paper promises break, physical metal doesn't. Silver dealers like JM Bullion, APMEX, and SD Bullion are reporting record demand for physical coins. Premiums on American Silver Eagles are now $5 to $10 over spot. $5 to $10. That's a 15% markup just to get the physical metal in hand. That premium is the market telling you something the official price isn't. Real demand is exploding. Now let me show you something fascinating. This exact setup happened before. October 2019. The Federal Reserve was paused. Inflation was rising. Geopolitical tensions were elevated. Silver was sitting at $14 an ounce. Everyone thought it was dead. Then the Fed pivoted. Real interest rates compressed. By August 2020, silver hit $29, a 100% gain in less than a year. And here's the key. The big moves happened before the official Fed pivot. Insiders started buying months before the news headlines caught up. Now look at 2025 and 2026. The same pattern is playing out. Silver went from $29 to $121 during the easing cycle. Then it consolidated when the Fed paused. We are now at the consolidation phase, exactly where we were in late 2019. The June 16th and 17th FOMC meeting includes a new dot plot, the first under incoming Fed Chair Kevin Warsh. This is the next major catalyst. If Warsh signals dovish cuts due to recession fears, silver will explode. If he signals hawkish hold due to inflation, insiders will accumulate even more aggressively at depressed prices. Either way, they win. So what specifically are insiders responding to? Three forces. Force 1. The supply crisis remains unsolved. Silver is in its sixth consecutive year of supply deficit, 46 million ounces projected for 2026 alone. COMEX vault inventories have dropped 70 to 80% in 2 years. This isn't a future problem. This is happening right now. Force 2. The Strait of Hormuz situation is escalating. Oil prices are surging. Energy costs for silver mining operations are exploding. Most of the world's silver comes from Mexico, Peru, and China. When energy costs rise, mining margins collapse. Production gets harder, not easier. Force 3. Central banks are accelerating purchases. The People's Bank of China added gold for the 18th straight month. Their reserves now stand at over 2,300 tons. Central banks bought $37 billion worth of gold in just 1 quarter. When governments dump dollars for metal, individual investors should pay attention. Insiders see all three of these forces converging. They are positioning before the broader market catches up. So if you understand what's happening, what should you actually do? Let me give you 4 practical steps insiders are using right now. Step 1. Prioritize physical over paper. If you're going to own silver, own real silver. American Silver Eagles, Canadian Maple Leafs, generic rounds from trusted dealers like JM Bullion or SD Bullion. Paper silver works for trading. Physical silver works for wealth preservation. Step 2. Use dollar cost averaging. Don't try to time the bottom at 76. Buy a fixed amount each week or month. If silver drops further, you get more. If it rises, you have momentum. This removes emotion from the equation. Step 3. Add physical-backed ETFs to your trading account. PSLV is the Sprott Physical Silver Trust. Each share is backed by real silver in Canadian vaults. This is the best of both worlds. Liquidity of an ETF. Trust of physical backing. Step 4. Position size matters. Most advisors recommend 5 to 15% of your portfolio in precious metals. This is insurance, not gambling. Don't blow your savings on a single trade. Stack consistently, hold long term, stay disciplined. That's the insider playbook. Let me bring this all together. The Fed made a mistake. They are trapped between sticky inflation and slowing growth. The most divided FOMC vote in 34 years tells you the policy framework is broken. Insiders aren't waiting for the next FOMC meeting. They are accumulating physical silver right now. The paper-to-physical leverage ratio is at historically dangerous levels. The 2019 pattern is repeating. 3 major forces are converging. Now here's the truth nobody wants to say. Most retail investors will not act on this information. They will wait for the headlines. They will wait for silver to break out. They will wait for someone on CNBC to give them permission. By then, the move will be over. Generational wealth in precious metals isn't built by timing the perfect bottom. It's built by understanding what's happening and acting before the crowd catches up. The Fed just gave you a signal. Insiders are responding. The only question is, what will you do? In my next video, I'm breaking down something even more important. The gold to silver ratio just compressed from 62 to 55 in a single week. One of the fastest moves in years. I'll show you exactly what this signal means, the historical patterns, and the precise strategy insiders use to maximize returns when this ratio normalizes. This is the most under-discussed indicator in the precious metals market, and it could determine whether your next silver position returns 50% or 500%. You don't want to miss it. Hit subscribe so YouTube notifies you when it drops. Before you go, I want to hear from you. Are you buying physical silver right now, or are you still waiting for confirmation? Drop a comment below. I read every single one. If this video opened your eyes to what's really happening, smash that like button. It helps me create more research like this for you. This is not financial advice. Always do your own research before making any investment decisions. Stay informed, stay disciplined, and stack smart.